We had a rebound today. Nice little rebound off of a really cruddy performance last week in the stock market. Is this rebound enough? Was that pullback enough? So we're going to see what this means heading into the rest of this week from a technical standpoint. Yes, a lot of it was Boeing. A lot of the weakness, like in the Dow Jones, was due to Boeing. A lot of the strength today was due to dovish Fed expectations. We're going to reconcile all of that from a technical standpoint, and then look at an area that really bounced the most. So we can say, okay, if the market does bounce, how are we going to take advantage? What's one of the best ways to take advantage? So let's go ahead and get started. Today is Monday, March the 11th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off looking at the S&P 500 with the market forecast indicator. You can see the nice little bounce we had today, reversing the past few days' losses. Almost the last 3 days worth of losses from last week. 40 points all in one rally, right back up above that moving average again. So that moving average will turn green just as quickly as it turned yellow. The posture will still stay pink, as well it is still pink because the intermediate line is still dropping. The momentum line jumped up, but didn't get to an extreme, still below that 90th percentile. The near-term line also jumped higher. Now the question is, it is as of right now at a bearish level. Like it would be between 50 and 80, and it would be a lower high compared to the previous one. So, we're not out of the woods yet. This is a great bounce today in terms of re-engaging this bullish trend. But, it's only one day, right? And we talked about in previous videos that while the idea is that we may continue down towards Fibonacci support here, it wouldn't all be every single day a down day. There will be some up days and some down days. There'll be some volatility with where the VIX is at. And so we had a volatile move to the upside today, and we'll see if it holds, right? If it holds through into the rest of the week, because if it doesn't, then all that does is set up a bearish near-term high potential with the near-term line at least not yet getting into the upper reversal zone. Barring, unless we really drop. If it's a small day tomorrow, pretty good chance that near-term line will get up there, or at least get close to it with how bullish the momentum line was. And as soon as that near-term line does get above 80, that intermediate line is going to turn back higher again. It's going to be bullish again. And remember, this isn't an intermediate pullback, right? Because it's got the green line, the intermediate line's got to get below 50. Excuse me. Sorry about that. It's got to get below 50 for it to be an intermediate pullback. So this is a weak bearish move, which is really just a bearish short-term sentiment. That's it so far. Like I said on Friday, we didn't even get to the 23% Fibonacci retracement. So, big time grain of salt in terms of how big of a pullback that was. It seems bigger because it was, 8 days out of 9? 8 out of 9 days were to the downside. But those were small losses. And, there was a couple bigger losses here at the end when we kind of broke through those lows. But even Friday, we didn't stay at the low. Like, we came well off of the low. So, that was about as less bearish of a 8 out of 9 day losing streak as you could possibly have, especially considering you didn't even get to the 23% Fibonacci retracement of the intermediate rally that preceded it. So not an intermediate pullback, just a bearish short-term sentiment. And as of right now, we're bouncing. The question is, are we going to bounce up? Remember, this is a significant level. There's that Fibonacci resistance from the decline, but there's also these old highs right there too, right above 2,800. So to get up to a new high, to get up to a bullish high, which would be the near-term line getting above 80 and a new high in the index, would be significant, because that would be a significant resistance breakout, as you'll see here on the Bollinger Bands as well. And from SPY, you'd be getting outside of the 70% zone of volume over the past 52 weeks. So that would be a significant move to get up there, and a breakout that holds, not a fake out, right? Because that fake out is a breakout that suckers you in and then comes right back down within a day or two. But a breakout that holds will then lead to a nice, good extended bullish run that we've been expecting for the rest of the year anyway, despite the expectations in the near term for an intermediate pullback. So that's what we're seeing right now on the market forecast. A nice little bounce, but not not too strong of a bounce. The Dow, of course, didn't, but you did get a bullish engulfing pattern here because of the Boeing. Remember, this is a price-weighted index, so Boeing has probably too much of a weighting in this, considering 1 out of 30 stocks. I don't know if that's a 1 out of 30 stocks you want to have a significant weighting, but because it's got the higher price, and this is a price-weighted index, you had a big gap to the downside, but you notice it didn't hold either. So you have a bullish engulfing pattern there, and also didn't have as bearish short-term sentiment. The Nasdaq Composite did, and it's bounced a similar, almost reverse the past 3 days, similar move to the S&P. The Russell 2000, little different story, right? It's been more bearish during the pullback, and it's been a nice good bounce up, but not nearly to the same extent. Remember, that's what we need, right? It's the Russell 2000. It did have a bigger percentage move today, but it's still got a long ways to go to get up above 1600, which is its equivalent significant resistance level based on multiple touches and the previous high and all of that. And it had a much more bearish, extreme bearish short-term sentiment. So again, still setting up for what could be a bearish near-term high compared to the previous near-term high right there. So we're not out of the woods yet. One day does not a reversal make and re-engage a new intermediate trend. Right? We expect an intermediate pullback. We expected ups and downs during that pullback. And as of right now, today's up was nothing more than that. It just happened to be a pretty big up because of the Powell interview last night on 60 Minutes in terms of what could be considered still a dovish Fed, but it's not we're not up enough to break through recent highs and now engage without that intermediate pullback, without that exhale. Again, you would consider this, it doesn't seem like a shallow exhale because of how many days in a row we were down, but the reality is, to the extent compared to the rally we've had, it's still just a shallow exhale. It's not that solid intermediate pullback that you need to set you up a more solid base to bounce off of that can last longer. Alright, a quick reminder before we look at some other charts here. Subscribe to our YouTube channel, mouse over our logo right here in the bottom right corner of your video. Hit that red subscribe button that pops out. Click the thumbs up icon down below the video. That tells me and Brandon that you want us to do the video again tomorrow. It's a quick, easy way to give us feedback. You can do that right now while you're watching. Comment down below on what stood out to you in today's video. What did you get out of it? Or any questions or comments you have about what we discussed or what we didn't discuss. Join our Daily Market Outlook email list. There's a link popping out up there in the top right corner of your screen. Click on that link. Really easy way to subscribe to our list. Follow me on Twitter for more content in between videos from day to day, and also join our Market Outlook community that we've created on Facebook. Alright, also, while you're watching the video here on our blog, you can scroll down below the blog. We're looking for 3 clicks here. Number 1, click on this heart. That opens up a new window where you can like today's Market Outlook tweet. 2, click on this image, takes you to your Facebook account. You can like today's Market Outlook Facebook post and be able to share that with your friends as well. And then finally, the 3rd like is right here. Click this button down below. That lets us, again, those 3 clicks tell us you want us to keep doing the videos. Easy way to give us feedback. Also tells these social networks that you want them to keep pushing you our content as we put it out there on those networks. So you don't usually get everything that you follow because of potentially how many people you do follow. So in order to make sure that these networks push you our stuff, you have to engage. And the really easiest way to engage with us is clicking on that heart. There's our calendar for upcoming classes. My options class tomorrow, which we haven't done for a couple weeks. I've been gone on vacation. And then you have the Brandon's DGI, Dividend Growth Investing, very, very popular class. So make sure you stay tuned in for those here and the rest of the week. All right, back to the charts. I thought we were going back to there we go. Back to the charts here. You can see, again, one day does not make a weekly candle. But so far, a little bit of a Harami inside week. Still a bounce up. We never did get the death cross on the pullback, and we didn't quite touch that 40-week exponential moving average. Came pretty close. So a little bit of a bounce up here. Again, from a Hakinyashi standpoint, we talked about last week's being a transition week. So far, this week's would be a transition week too. Still a transition to the downside, right? So we're going to keep our eyes on that Hakinyashi candle to see whether or not the next candle is a big bullish candle like these that preceded this transition, or a bearish candle like these, which is what we'd expect. It doesn't mean it has to happen. You see here, we didn't get a bullish candle after those transition candles, and we ended up with another bearish leg to the downside that we then bounced off of. So whether we get that last little push, exhaustion push, where we run out of air because we haven't exhaled all the way up here maybe to 2900, or whether we actually do get the transition that we expect, we'll see as we monitor these Heikin-Ashi candles. If you take a look at the 3 green arrow chart, we got 1 green arrow, right? The MACD is not green yet because it's down there. The stochastics hasn't turned up with that phantom green arrow yet. When you look at the 2-line versions, you can see all the way back above the 8-day moving average that quickly. MACD did turn up, didn't cross below 0, so it did turn up. It's still below its moving average, so the histogram doesn't have that green arrow yet. And stochastics also below its moving average, did not turn up quite yet. So those are, they're still, again, one day doesn't change this, change this pullback that we've got, and we need to get these things back above their moving averages before we can say, okay, we're starting this next bullish leg to the upside. Again, we wouldn't expect that bullish leg to last too long because we haven't had that nice exhale yet, but doesn't mean that we can't get it, right? And so you'll feel more confident about it once you get up above these moving averages, which will most likely coincide with us getting above those recent highs. All right, now let's take a look at the intraday charts. Here we go, and you can see a higher high and a higher low. We gapped up, we held the gap, we didn't retest, we held the gap. We pushed all the way up above the purple line, which is the Heikin-Ashi open. So we have a high, we have a upper shadow. We also obviously have the lower shadow too, transition week on that Heikin-Ashi candle. But we did close easily up above Friday's high point. We are stuck in the middle of last week's range, so we're not out of the woods here on this bounce. We're still mired in this range, and obviously mired in the 4-week range. And you remember, this will come off today. We'll move it up to this point, which means that dotted line will move up, and every day this week we'll move it up even more. By the end of the week, we'll be all the way up here, which means the dotted line will also be up the same amount by half. Up to the upside, which will probably end up being right around this area. So this range, unless we get to new highs this week, which still doesn't look as likely, but it's possible, unless we get to new highs this week, by the end of the week we're going to have a really, really tight range, especially compared to what we've seen in the past, and that typically leads to more of that pullback. So again, if you can break up through those highs, great. If we can still push, we can keep the range wide by pushing the high up as the low comes up. But unless, even if we push it up a little bit, this high point's going to go from 267, 1, 2, 3, 4, 5 days. So we're going to be all the way up here to 276. So we're going to move up about 9 points on that 4-week low point. Most likely you're not going to move up to 9 points because that would be getting up to all-time highs to get up to 290 on the high, on the 4-week high point. So the range is going to tighten up considerably by the end of this week. And like I said, tight ranges, and that would be about a 5-point range. That typically leads to weakness, and not like a bear market. So don't put words in my mouth in terms of that, but just that that intermediate pullback that we expect. Let's take a look at the volume and the range today. So where are we at? Let's go to the 3 green arrow chart and let's look at SPY. I remember the gap, so we had a little bit of a gap here. We closed at 274.46. The low is 275, so almost a point of a gap, about 3/4 of a point. So you have to add on 3/4 of a point there, and you're looking over 4 points, closer to 4 1/4, well above the average here. And the volume, of course, at 63 million, not really that strong. Again, remember, we're missing some data on this. But when you look at, whoops, not that one. It is the grind there. You can see the volume at 63 million is just right about, it's still in the low end of the 52, of what was the 52-week range before we got these zeros that really brought the average down. Same thing with the trading ranges. The zeros really brought these down. The range at 4 points is kind of in the middle of the 4-week range. So pretty pretty decent sized range for a move that wasn't a break. We're not breaking out. We're not bouncing off a significant low either, which is usually when you get the bigger moves. So it's kind of interesting to see. It's well above 1%. Like I said, pretty indicative of an intermediate pullback. It's not going to be a down day every single day. There's going to be ups and there's going to be downs, and it's still not quite the up that you would trust to hold, right? To basically say that this is the low point that we're starting a new intermediate run with. Take a look at the volatility, and we're back down to the lower end of the neutral range, and we've held so far for support. So we're going to see if that ends up being this higher low. Here we go with the MACD and stochastics. If this ends up being a higher low or even an equal low compared to the last one, there's going to be some support here in volatility, an opportunity to see if it bounces up or if it breaks. If it breaks this 90% and holds that break, then we're through, right? We're through to the bullish side of things. If we bounce back up into this area again, like we did here last week, then we still got some pullback left to do. And again, that's the expectation. You expect support to hold, obviously, until it doesn't. Then you make your expectations changes. All right, so what do you think about that outlook? Do you agree with that assessment? Do you disagree? There's a poll popping out there. Click on that poll. Click on that link, then it opens up the poll. Then hit either agree or disagree. If you click disagree, scroll to the comment section and let me know what you're seeing that would suggest otherwise. Again, like I said, maybe you think this is the pullback we've been looking for, or maybe you think there's that this was even more of a less of a bullish bounce, like more of a fake out than even I think it is, that we have a lot more to go to the downside than just an intermediate pullback. So if that's the case, everybody's got their opinions, but let me know what's fueling that. Like, what do you see on the charts? What macro events or things that you want to share with the community that lead you to having that assessment? You can scroll down to the comment section below. All right, now let's take a look at what's fueling this price action today. You can see the biggest movers to the upside were the biggest gainers previously that had pulled back last week, and that is emerging markets and small cap stocks. You can see the weakness in the dollar helped fuel that. It didn't help fuel a higher move in gold. Gold's been pretty bullish too. We'll take a look at here in a second. Gold's been pretty bullish as well, but it's still pulling back lately. And you can see crude oil, interestingly enough, actually has underperformed the S&P 500 and small cap. Usually, in a bullish environment, that's one of the big. That's your higher beta asset class is crude oil. So it bounced up, but not to the same extent. You can see developed markets lagging seriously behind, especially emerging markets. About half the gains is what you can see. In fact, if you look at the foreign markets over here on the right, you can see France. So here's ACWI, which is all country world, and at the bottom you got Germany, UK, and France all really lagging behind. There's Australia and Canada as well. There's a few. Thailand and Poland and Turkey at the bottom. There's Spain and Italy, the kind of emerging markets of the European Union. Japan's up here along with Taiwan. Brazil is a bigger gainer. We don't have these updated for whatever reason. But Brazil's got a big gain this week, and China and Russia both outperforming the S&P with a nice little rally, and India also rallying. It had a bigger, it's had a nice little bounce here over the last couple of weeks, and a little bit of a pullback late last week, but nice little recovery today. In fact, if you take a look at all the all the biggest economies here, including Germany and UK and France, along with China, Russia, and India, and you can see India way up to new 3-month high points. So big time move there. Brazil bouncing, pretty much everything bouncing today to some. To lesser degrees than others, with having, like you can see, Korea and Japan and China having pulled back, smaller bounces there. France and UK and Germany also smaller bounces, similar looking to what we're seeing on the S&P. All of those have bullish postures, minus Germany and the S&P 500. And Japan's got the weakest intermediate line there at 48. Russia also kind of flatlining here, but obviously a lot closer to its 3-month highs than its 3-month lows. And then you can see Canada kind of coming off of that Christmas Eve low point with a nice little rally to the upside. Also bouncing just a little bit, not very much. So these kind of bigger developed economies lagging behind your bigger emerging market economies today. From a macro standpoint, you can see today's retail sales number was expected to be a small bounce, and it was a little bit bigger than expectations. You can see the year-over-year rate, after declining pretty sharply over the last so many months, bouncing up a little bit. We've seen this before. Broadly, you can see from an economic indicator standpoint, they're still relatively weak from an economic surprise index. It hasn't been updated for today, but coming off of Friday, still very, very negative globally here and in the U.S. That's going to keep yields lower. That has the potential of keeping yields lower. And also the idea that there's 0% odds of a rate hike anytime this year is also going to keep yields lower. So when you take a look at the 10-year note, and we'll just go to a daily chart first. You take a look at the 10-year note, and you can see, a little bit of a bounce today, but very, very small, and still below that falling moving average, which is we got a bearish posture with combination with the red line, that's bearish move, and we're a lot closer to potentially breaking through these lows than we are to breaking above these highs, 2.8%, and back to the upside. So that's less likely, not 0% chance, because nothing's ever 0% or 100, but less likely we'll break through that 2.8%, more likely we'll break through the 2.6%. To the downside, considering the way that yields are going and what's driving that very, very weak economic picture showing up. You can see with the retail sales out, the GDP estimate for the Q1 is down to 0.2%. So very, very, very low estimates. Things from an economic standpoint are not looking nearly as bullish as we have seen over the past few years. From a sector rotation standpoint, you can see the effect Boeing had on sectors right off the bat. Industrials were the only sector that was negative, down 1%, but of course it rallied. Finished weaker, but again, this is the Boeing effect. You can see utilities also a little weak, staples. Real estate was weaker for most of the morning. You can see the nice little rally real estate had throughout the day to finish outperforming. Same thing with the staples lagging behind, but closing a lot of that gap by the end of the day, whereas technology was strong at the beginning of the day and stayed pretty much at the same level of strength all throughout the day. Really outperforming, and the communication services outperforming as well. If you take a look at the sectors or the stocks within the S&P 500 that had your best gains today, you can see here in the information technology, you got Seagate and Nvidia and Western Digital, AMD, Apple with a nice little run, NetApp. From a communication services standpoint, your games, Amazon had a good day. That's actually in consumer discretionary. There's Google down there. So all your FANG stocks, most of your FANG stocks, there's Netflix down at the bottom, and Twitter, and even FedEx rebounding a little bit. All of these were your best performers. So kind of a little bit of a, these were the ones that had pulled back a little bit the most, and they rebounded. There's obviously nothing that fueled that rebound from their no earnings announcement or anything necessarily that fuels that. But this overall sense of, a dovish Fed helped rebound some of these stocks that had pulled back the most, that were lagging behind a little bit. And then you can see on the other end of the spectrum on the weekend, there's Boeing, but you can also see, some other companies. This is kind of broad, a little bit of a broad. There's consumer discretionary, there's materials, of course, with gold lagging behind. You can see lots of consumer discretionary names, and airline, Alaska Airlines down there, utilities, industrials, consumer staples, some of those names you'd expect to lag on a day where the market's broadly up. And really, they've only lagged behind a little bit. The only big losers you can see are these names at the very top of the list. All right, I mentioned Seagate Technologies in that list as one of the stocks in the technology sector that really did well. Look at the chart today. Look, that's a nice, good breakout move, following up on a pretty decent move on Friday that it had. You can see the Bollinger Band width is really low relative to its range that it normally has. Big time break above, breaking into an area of lower volume, still inside the 70% channel, and the biggest amount of volume is way up here at 57. So it's got some room to really make a run here. over the next, especially with, you got earnings coming up here in April. But it's got some room to run through and then see what we've got head until we get up to that 57 area where the next layer of resistance is. It's a nice little breakout pattern. If you take a look at the long-term view of it, pull it back, you can see how we've been kind of flirting around this 200-day moving average until today's little breakout move. Still doesn't have that golden cross yet. Then you can also see too from a 3 green arrow standpoint, the 3 green arrows, well, close to 3 green arrows, and a pretty decent amount of volume relative to its average. Here's what those 3 green arrows look like on the two-line versions. MACD really close to getting above its moving average again. Stochastic is crossing above. Not only did it turn up with a phantom green, but it also is crossing up above its moving average here. And then finally, when you take a look at like the DMI, a little breakout move that it had, and pull up these other DMI indicators here. There we go. You can see bullish all across the board with a cross up above its negative line and up above the 25 level. Good bullish patterns across a lot of these indicators. Finally, look at the market forecast for Seagate, and you can see dark green shading with the green line. We've seen this before. This combination before led to a nice little rally off of a breakout move with earnings in the middle. So we're going to look to see if we can take advantage. Big time bullish short-term sentiment here, and a turn up to the upside with rising long-term market sentiment. Remember, this is where the next layer of volume is, so we can look to do, let's see, let's go out to May, past that April expiration, so into May expiration, and we can look at buying this at the money call option. It's only $350. We can set a stop order at half of that, so we can get out with a $1.75 loss if it doesn't make a move to the upside. Knowing that you've got about $9 of potential reward and intrinsic value to the upside, minus the $2.29 of extrinsic value that would eventually waste away as we get closer to May expiration. So there's a nice, quick, easy swing trade that we can be able to take advantage of this nice breakout move that we're seeing in this stock. In a sector that's leading the way higher today, that we would expect to lead in any kind of bullish intermediate trend. That way, if we don't get this pullback that we expect over the next month or two, and the market does stay bullish, here's a way to take advantage of it according to what the market's telling us today. Alright, so that wraps us up for today. Now I want to hear from you. Remember, there's that link up above the video where you can participate in our Market Outlook forums on MarketScholars.com. Questions, comments, anything I discussed in the videos, fair game. Anything I didn't discuss in the video, make sure you open a new thread there in our forums. Also, remember, you can reply to other people's threads too. If you see an interesting topic that somebody's opened up, make sure you reply there as well. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Click the thumbs up icon. Let us know you want us to keep doing these videos. And then comment on anything that stands out to you. Follow me on Twitter for more content between videos. Join our community on Facebook as well as on MarketScholars.com. And then we'll see you all next time. Have a great evening, everybody. See you all in our next video.